Once again to another episode of the monthly market update with Simon Brown. My name is Dineo, and today we're joined by Simon, and we're going to be talking about the very, very depressing month that was October. Simon, welcome.
Thank you. It was depressing, except I did have a birthday and a holiday, but neither of those really offset the what was a very... So quick stat before we get it. 24 October, during the course of the day, early morning in fact, our top 40 officially hit bear market. From the intraday high in November last year in the lead up to Nasdaq down to the low on 24 October, we were off 20%.
Yep.
So if you've been in the market for less than a decade, it's your first bear market.
Yeah.
Welcome.
It's bound to be a very interesting time in bear market territory, and I think it didn't come as a shock, but a lot of us were hoping it wouldn't get to this. But here we are. We
did expect and maybe less of the we and more of the I, but there certainly was in post Nasdaq, and we expected a much better year for South Africa, for SA Inc. We've been hit by a couple of whammies that have, we also hit recession. And whilst we're probably out of it by Q3, not by a heck of a lot, the VAT increase. We kind of saw that coming, but coupled with that was petrol price increases and a consumer who's just been beaten down, and a stock market that just got walloped. And even the offshore component of it didn't really save us. Even with, the Rand was 11.55 when President Ramaphosa announced his cabinet in February. We went to almost 15. That hasn't saved the offshore, because that strengthening was so short in terms of duration. I mean, we rushed down to sub 12 and we pretty quickly rushed back up to north of 14. So we weren't even saved by the sort of offshore components. Your classics, your British American tobaccos, Richmond, and then of course there's Naspers. But
so before we started recording, Simon and I were having a chat about the top performing companies in October, and then year to date, and then just over the past 12 months, and it really, really is a dismal picture. I mean, if we look at total returns for October, we've got Into at the top, Harmony, Sibanye, Anglo, Goldfield. So resources really surprisingly carrying the market, which isn't surprising, I suppose, but surprising still.
So and Intu's an outlier because remember Hammerson late last year we're going to buy them out. That offer collapsed. They've now said that there's another offer on the table. It's been extended. We don't know, the timeline has been extended. We don't know terms, prices, who it is, etc. But hence Intu at the top. So we can remove them from the equation. And then it's gold miners, which were helped in part by better production numbers, with some exceptions, Sibanye being the exception, helped by a slightly more robust gold price and a weaker ZAR. But if you weren't sitting in a gold stock, October was terrible. You'd rather it didn't happen.
And besides the resources, so we pretty much go down to about 31 places, really, 31 companies, and then we're in red territory. And I mean, to look there, at early reds, we've got your Vodacoms, you've got Anglo, you've got MTN Group, but on the extreme side, Tongaat, worst performer.
Yeah, so Tongaat, and I mean, I'd liked Tongaat for a while on the whole rain is returning scenario, and I held it for about a year or so, and I sold it maybe early this year, maybe late last, and I was at break even before broker fees. I had small loss, but the dividend covered that. I think I was in at 114 and out at 114, including dividend. And the logic was quite simple. Their starch business, fairly stodgy, plubs along, probably giving you low single-digit growth. Their sugar business returning to production volumes, which will help them. The weaker rand helps as well. And what would then happen there is, as they produce more, of course, that then pushes the price of sugar down because supply is up. But you hope that they produce quicker, then the price comes down. And that happened. But the import protection, which they have, didn't kick in until too late, and then too little, so that hurt. And then their land was just a disaster. So land for them, which is mostly out north of Durban around Hillcrest, Assegai, and then, well, I suppose that's inland, and then north up around Umhlanga area. They're converting their previously sugarcane land into commercial, industrial, residential, making a huge success of it. But it's lumpy because these timelines are often long, processes are long, so sometimes they do R1 billion and sometimes they do $500 million. And this time they literally sold 1 hectare. So if me and you had clubbed together and bought a second hectare, we would have doubled their sales. So land sales absolutely collapsed. Sugar didn't deliver as we had hoped, and that left them with just starch. And I'm talking about exiting at 114. That stock was down in the 40s at one point. Concerns around their balance sheet and perhaps a need to raise capital to do a rights issue. They've got some big expansions going on, I think up in Mozambique. And it just, the story as it was expected to play out just absolutely has not. Now, the question is, therefore, is in the 50s, and in fact, I think they're this late. We're recording on the 6th. They're back up to around into the 60s. If they can get their land sales going again, then that should start to boost their earnings. There are a couple of issues. I mean, is expropriation without compensation a concern? I don't think so. Everything we've seen, I mean, lots of hysteria around it. But we're not seeing any indication that bonded or privately owned land is going to be ripped out from areas. But it's still, this is not an economy where there's huge confidence. And land which you buy to then develop on requires confidence because this is a long-term 2, 3, 5 years to get it going. And sugar's hurting. And what we knew was coming and hurt more than we thought was beet production in Western Europe. And there was some, it was always capped and then suddenly it was let free, and beets is another, along with sugarcane, big source of sugar. And that has taken a lot more than we thought. So sugar price has remained under pressure. Weaker rand helps a bit. But at this point in the equation, in one sense, it looks attractive at 60. It looked really attractive in the 40s. I can't buy it. And I was looking up on the threat of drought next year, and I couldn't find anything for South Africa, but I could find the Australian Weather Service is basically saying a 70% chance of El Nino again next year, which is a mini drought, not as bad as the one we saw a couple of years ago. Shouldn't affect the Western Cape because they're in a different rainfall pattern to what we are, although maybe they get their own special little drought. But that then hurts again. That's then going to hurt. So Tonga, the worst performer, and at this point, I mean, if you bought in the 40s, you're looking pretty. I think you're brave if you're buying in the 60s.
Okay, and, well, yeah. So I think the other perhaps somewhat of a surprise for me anyway, although I guess if you look at where all the other financials are, all negative, between like 5s and 6s, but you've also got Coronation down 8.8% in October. And this is uncharacteristic.
It is. So Coronation, obviously the largest listed asset manager in the country. I think Alan Gray might be bigger. The PRC certainly is.
Yes, yeah. But unlisted. So.
Yeah. And in fact, Old Mutual, they've got about 600 billion. I truthfully don't know where Old Mutual sits in that game. But nonetheless, 600 billion. They're a significant player. Their assets under management have been slipping. Last update, they were down about 4%, and the market was up 1 or 2, including dividends. But their biggest challenge is obviously, the theory being that asset managers can outperform in falling markets is to be tested, and we will start getting some updates coming through. I'm not so convinced. But Coronation had a couple of big hits, Aspen, MTN, and if we go back to December last year, Steinhoff, were all big holdings for them. However, what these stocks in a raging bull market, I mean, let's forget performance fees right now. So that would also then bring Insignia and Anchor, who's the baby in the group. You know, if they've got 600 billion and market grows 15% and now they've got 700 billion, next to say they're making 1%, well, that adds 1% on a billion, on 100 billion. That's an extra billion to their bottom line. Costs don't increase one bit. 1%. So bonuses do and all of that, but your operational costs stay the same. So what you're almost getting right now at the current level, sub 50 on Coronation, forward dividend about 10, maybe it falls to 8. You're getting paid 8%, and you're essentially almost buying a call option on the market. When the market starts to boom again, Coronation will rally. You're getting the 8%, 10% to hold it in the meantime. And it is looking on all metrics. One of the metrics is assets under management relative to market cap and the like. You look at all of those metrics, they're a standard deviation below the average. The stock is cheap. I just don't, the question with a cheap stock is what's going to trigger the re-rating higher. With Tonguat, not sure. With Coronation, raging bull markets would certainly help.
We need that.
and I don't know when that's coming. My prediction was for 2018. I've got 7 weeks left, but I'm not putting lots of money on those remaining, actually 6.5 weeks. But it's an interesting play. I think it's worth a stab, and I've written about this a lot. In fact, we spoke about it on Business Day TV last night, where you're getting paid above the bank rate to hold essentially a call option on the market. It might go lower. I don't think it can go very much lower at current levels because at some point it just becomes too cheap. The last point, the big risk, is of course that they struggle to outperform. 600 billion is a lot of money to move around. Yes, they're looking global, but their great performance fees may be behind them. But even modest performance fees on 600 billion is nice revenue.
Okay, now turning to total returns year to date, we've got some perhaps not so surprising, some very surprising guys up there, but worst bottom performing company for the year is Blue Label, down 65.2% in Rand terms, 81.4% in US dollar terms. So that's a pretty big...
It's a horror show.
And... I think the Blue Label situation is, I don't know about others, but I've found it very difficult to be like, okay, what exactly is going on?
So, and the stock listed a decade ago and is now trading below that listing price of 2008. And had a really great little business model. If you're buying virtual airtime at a petrol station or electricity or any of those sort of things, you're using their point of system. And what they have is they have that network distribution, and now they can add new product into it, and everything's lovely in that sense. But then they bought Alsi. And there are a couple of concerns around Alsi. The one is that, do you want to really be player number 3 in a 4-player market? And we look at it in the US. You want to be Verizon or AT&T. I think it's AT&T. You don't want to be Sprint or the other one whose name I can't even remember. You don't want to be number 3 or 4. It's tough. Your critical mass, your OPEX expenditure for new towers, which is a ongoing expense, your move in terms of data prices going down. Now that's very elastic in that prices go down so people consume more data, but data ultimately is a utility. They're trying their Black, which is a sort of a Netflix or Showmax type of competitor. And we can see this play out in Europe and North America, where the telcos mature and they try everything to remain relevant, and they buy Yahoo and AOL and all of that.
And it just doesn't work.
And the evidence is it doesn't work. Alsi also has a fair chunk of debt, although much improved post the purchase. But the numbers were not thrilling, and that really is the millstone around their neck. Now, I know people who have spoken to management, the Levy brothers, and they remain very bullish on it. But the market is saying, no, the market is just not interested.
Doesn't want to buy it.
Yeah, and at this point, what's going to trigger it higher? I suppose vastly improved numbers from Cell C, and the medium-term game, 3 to 5 years, is probably a planned listing of Cell C. But there were also some for example, big direct payments ahead of the purchase by Blue Label, and etc. And I don't see this coming right anytime in a hurry just yet. And it's partly, so last year's one was consolidated infrastructure. The high flyers fall, and there is a negative sentiment towards them that is slow to change. The valuations might be cheap, and maybe the Levy brothers are right about Cell C and everyone else is wrong. That might be true, but the sentiment is slow to change because people remember those losses and the pain of the losses. And that's everyone from private clients, me, you, the listeners, truthfully, through to fund managers. I sit in an investment committee, unit trust, and it's going to be a long time until that unit trust buys Blue Label again or consolidated, because they held both.
And they're not happy.
No.
Okay, so maybe let's turn our attention to some of the medical stocks, and let's first touch perhaps on Mediclinic. So Mediclinic has gone through quite a bit in terms of finally, the Middle East, they cracked that market. What they were hoping for happened, and then Switzerland happened.
And then Switzerland came along. And stock closed on Tuesday below 70. Brad Kamala was telling me, and they're Vestac, a big shareholder there, price earnings of 13. That's probably reasonable. I mean, so the medical, the hospital industry is quite nice. You like a hotel, except that your stays are forced, and hopefully the medical aid pays. And if you can get your bed nights up, your costs don't increase proportionally, and you get that wonderful operational leverage impact.
Yes.
But when it was flirting with around 200, it was chronically overpriced. It has absolutely collapsed. As you say, Switzerland now a concern. But there's a bigger issue generally in the medical space and in these services, which is regulatory. In medical, inflation has been well ahead of general consumer inflation across the world over the last 1, 2, 3 decades. Governments are not happy about this fact, and they're taking the view, rightly in my case, that medical is a human right, that being healthy is not because you're rich, but it's because you're human. And that is always going to be a threat hanging over them. Locally we've got the talk of a national health insurance. It's muddling along slowly, but it's muddling forward. And probably at around 70 rand and a PE of 13, Mediclinic is probably reasonably valued. Switzerland, expectation is they will get that right again. Al-Noor, unfortunately, was just a real dud that they purchased. And I don't like these medical stocks. The one exception is the generic guys, and we'll talk about Aspen in a moment, or the equipment manufacturers. The hospital bed or the MRI scanner, because those are one-off purchases. There's very little regulatory process there. And there's issues around that fake knee that you got. Is it made of quality, or is it made of, cheap plastic and won't last? But it's not a space I like. And yet the theme is brilliant, right? Aging population. We're living longer. We're consuming more medical. Absolutely brilliant theme. But I think we counter that with the regulatory, and they nullify each other. And
there's no growth.
Yeah, and the truth is, and we've had a lot of stocks in this scenario, flew too high to the sun. Stocks that were truthfully doing proper organic growth in the region of maybe mid-teens, sitting on price earnings around the 30, that stock's just chronically overpriced. And at some point, normality has to return.
Okay, and perhaps let's touch on Aspen, down 42.6% in rand terms this year.
So hit a low, around 140, back to around 160 last time I checked. So Aspen's another one, which frankly at one point was a price earnings of 40, and they were then buying mature businesses that had price earnings of around 10 or 12. In other words, their return on investments that they were making was way below the valuations. And again, it needed to come back to earth. They're buying end-of-life generics. There is absolutely a market for that. Without a doubt, there absolutely is. But these are mature, slow-growth markets. You're not going to get high double-digit in those markets. You're lucky if you get, sort of 11, 12% growth. So Aspen has very suddenly gone from a high-flyer growth stock into a mature X growth. And truthfully, that's happened over probably the last 4 or 5 years, but the market's kind of only woken up to it in the last sort of 6 or 8 months. At current levels, you're on a PE of around 12 for a mature generic manufacturer, probably not bad. The sale of their infant formula gives them some nice cash, helps them get rid of some of their debt, because their debt to equity certainly was looking chunky. A lot of excitement around directors buying 100-odd million of equity. Truthfully, I mean, Stephen Saad is one of the richest people on the continent, like billions of rands.
And probably a spare change.
It's like me and you dropping, a couple of thousand into a share. I mean, we've got to be circumspect with directors. So we have a very small. Your only other one is probably Adcock Ingram. A lot of people prefer Adcock Ingram in the space, but at these levels, you're not going to knock it out the park profits from it. But you've probably got a nice mature, playing into that theme of aging population, expensive medical, and both of those to a degree feed into the generic business.
Okay, and another one I wanted to touch on that's done surprisingly horribly this year. Curo, down 43%. I mean, this is supposed to be the company that is the solution to fees must fall, and
so Curo and Curo, and I'm trying to remember when they spun out Stadio. So does that include the Stadio spin out? And even if it does, it's still probably down 30-odd%. Problem with Curo, again, very, very expensive. If you look at their organic growth, it seems to, in some places, frankly, be hitting a wall. They probably got sufficient capital for their capex going forward, but the Meridian schools, which is the lower income and relative, to government schools, is really, really struggling. Their sort of mid-range schools are doing okay, but it's another one of those stocks which at 50 Rand had just really, really got ahead of itself in terms of valuation. Education is hugely defensive. Absolutely it is. Families will give up a lot before they sort of downgrade their children's education. At some point they do, and we've seen it certainly in the Advotech numbers. And if you lose a child in standard 10, grade 8 or something, other way around, standard 8, grade 10, typically a child goes through the whole 5 years of high school. You don't get many kids changing schools. So if a child drops out for whatever reason, Advotech was blaming immigration to a degree, for whatever reason, it's hard to replace. And your cost base, obviously fairly static. I like the space. I really do. My preferred stock, and disclaimer that I own it, is Advotech. They recently announced a purchase of Monash, which I think they're overpaid for, but it gives them proper degrees. They can open new campuses. And they've got an established brand and infrastructure there. Stadio's doing their big campus in Durbanville. That's going to cost billions of rands, and they're going to need rights issues. So Curo, and this was, and particularly late last year with Nasrec and the return of SA Inc. and President Ramaphosa and all of that, a lot of our SA Inc. stocks got bid up to crazy levels. And shares can stay crazy expensive for a long time, but ultimately if those earnings don't come through, there's going to be a return to some rationality in the process.
Okay. Well, okay, maybe onto some somewhat better news. Although down in October, Mr. Price has been the top performing share in the past 12 months. South Africa followed closely by First Rand and Santam. And actually pretty much financials and then a few other, the second retailer up there is the Foschini Group. So retailers over the past year, at the very least, I think the past month and the past quarter not so much, but over the year have, I think when we, with the announcement of the VAT hike, one would have thought or expected that these would be the guys who, because they're directly interacting with the consumer, they'd be, biggest impacted. But like even Pick n Pay up 18.1%. So we've got really good numbers coming through, and it's weird even for like food retailers, because if you look at the food producers, they're not doing well.
Yeah. So the food producers are being squeezed by input costs and by the retailers. Pick n Pay says, "Do you want me to carry your biscuits? I need a better price." And hey, they Pick n Pay. You don't have a choice. Quickly Pick n Pay. Richard Brasher's sort of turnaround strategy finally coming to fruition. The one thing that they still haven't got moving is operating margin. I think they call it retail margin. Still sitting at 2%, exactly where it was 5 years ago. ShopRite historically has been north of 5, although ShopRite's trading update, which really was ugly, they dressed it with balloons and all, is going to squeeze their operating margins. And I switched out of Pick and Pay into ShopRite about 15 years ago, and wondering if I don't need to switch back the other way. But I'm a very slow thinker, so we can talk about that lots over the next 6 months. Mr. Price is interesting. So two things happened. They messed up last year.
Yeah.
And in fact, 2016-17, they messed up.
Actually, from like mid-2015, they've
got the
really
fashion
rough.
wrong, they got everything wrong, and that's going to happen. Look, if you Woolies seem to mess up their fashion every year. Mr. Price had a rare misstep over a 2-year period. That depressed the share price, but they got going again. But I think, to your point, why does an underpressed consumer go back to shop at Mr. Price? I think the answer is because Mr. Price is viewed as a cheap retailer, and much as David Neal at Clicks talks about the lipstick effect, times are tough, so you buy lipstick because it's not too expensive, but it's immediately apparent and makes you feel good. I can't help thinking that perhaps there's a Mr. Price effect in the same thing, where it's really tough out there, so to spoil yourself, you can go to Mr. Price and get something for relatively cheap. It's cash, so it's not on your credit, which is probably under pressure and got no wiggle room left type of environment. So I think it's a combination of getting their fashion right again and perhaps some lipstick effect in that space there. Our financials are broadly cheap to varying degrees. Some very cheap. Barclays Africa, well now ABSA, sorry, no more Barclays. ABSA banking, what bank, or whatever, the ABSA peeps. But our banks are fairly cheap, but also currently very, very volatile. I've got
Understandably so.
Yeah, and they're perfectly well capitalized and the like, but where's their growth coming from in an economy that is not growing? Per capita, we have been in recession probably for a decade and aren't getting out. We've got to grow at 2% just for population growth.
And it's not going to happen.
Not anytime soon. I mean, even the Reserve Bank and our new old governor, new finance minister doesn't think so. So really their growth, and we've seen it largely, has been sort of low single digit. Capitec, the one exception, although that too is slowing, and First Rand the other. Standard Bank perhaps the better positioned in that ABSA's got the new Africa, which they've got to make work and rebrand. First Rand's bought a UK operation, which they've got to integrate. And my sense is that Standard Bank's footprint into Africa
It's well established.
It's established. It's been there for more than 10 years. In fact, in the credit crisis, then CEO Jacob Maria was pulled out of emerging markets in London, Turkey, Brazil, Russia, but left the African footprint. So it's there, it's established, and there's certainly some growth prospects there. But in the local market, it's tough.
It's done.
It's tough. People don't have money. Yes, we want more debt. To their credit, the banking sector in South Africa, their unsecured lending has been stellar, which we can see from their impairments, which are sub 1% and in some cases around 0.5%.
So we're doing well. And perhaps just to close off, because always very interesting, Woolworths, and you did touch on this, but down 5.4% in the past 12 months. And is there light at the end of the tunnel?
There is, but we're still not sure that it isn't a train. So there is light at the end of the tunnel. So let's break Woolies into three parts. Local clothing, they've struggled with that for a long time. And in fact, on my way here, I need suits. I went to Woolies. I used to be a big Woolies suit fan. And look, I'm fussy. I want pure wool. They've only got linen and polyester, but they used to have. I mean, certainly, I used to buy most of my suits from Woolies, and then I would sneak off to a tailor and get them slightly, better fitted. But I just spent 20 minutes wandering around there and nothing. And it's a problem because I need suits. But anyway, so their clothing they have struggled with. And Ian Moores admitted this and said that they need to go back to their core demographic, which is the female, 40, 50 years old. But I think he said that before, and it bothers me. Food locally doing great, probably one of the better. They've really got their footprints right. Their location of the stores are great. Their product offering is great. They're innovating in some spaces. Their local food is doing great.
And I really have to commend them on that, because on Sunday morning made the mistake of thinking it's a Sunday morning. How full can Woolworths be? I left nice stuff. It was that full.
So the secret is, I used to live in a Jewish area, and I used to shop on a Saturday, and there would literally be more cashiers than there were people in the store. I basket for basket, probably Woolies is not the cheapest, but they no longer, they used to be the outlier in the expensive side. They still largely target high LSM, but they've really got their product offering right. Australia remains a disaster. They're chronically overpaid for it. We know this because they've written down a third of that 20 billion. They've written down 7 billion. They always say the write-down's non-cash, which technically is true, but it was cash on the other side. You paid the 7 billion. The fact that you now write it down just means that 7 billion vanished into thin air. Not insignificant. Will they get Australia right? And that really is the bet on Woolies. Do they get it right? It's the same with Famous Brands and Gourmet Burger indigestion, and I hold both, so I'm suffering. So what are their options in Australia? They can sell it at fire sale and just take what they can and run. That's not the worst option. It's cost them a fortune. I quite like a board that says this doesn't work. I remember Discovery lost $1 billion in America, and Adrian Gore said, "That's it, $1 billion. Hey, no more. Let's only lose $1 billion, not 2, 3, 5, 10 billion."
And then
maybe they can turn it around. I mean, maybe they can. There's certainly some challenges. Department stores generally are tricky, but there's still some around. We've seen Sears in the US, Die and others. So it's not a sure thing. But if we start to see signs of positive life out of the Australian operations, which will probably take another year or two, then we can say, look, that light really is a light out of the tunnel. If Australia continues to hurt, it's a train. And at $50, you're betting on management's ability, and let's be perfectly honest. So far, in the 2 to 3 years that they've had David Jones, they've failed. They've absolutely failed. Yeah. Can the same senior management team make a difference? Sure, but it's a risky bet.
And I know I said Woolworths was the last, but Famous Brands. So management doesn't seem to think that venturing into the very Great Britain was a bad idea.
Yes, and Ian Moore as well was asked on Bruce Whitfield's show, did you overpay for David Jones? And he said no. And I tweeted Bruce and said, which part of they wrote down 7 billion doesn't equal overpaid? And Ian slipped and slid, and then he refused to admit. So Famous Brands results, again, if you break it out. South Africa, doing all right under circumstances. They've dropped some margin that's protecting the businesses. They've got what they call their signature brands. I was in Umhlanga last month for holiday. They've got the Strip Lighthouse Road, of which about 5 of the restaurants are their signature brands. It's a Turn and Tender, what are they? Mythos, a whole bunch of them. And mid-month, October, Monday, Wednesday, Tuesday nights, there's 20 odd people in the restaurants. They're ticking over. The food is great. The value's decent. But this is a hard consumer. But again, they would be doing fine except for the UK. Management, so they've put it into our equivalent of business rescue. It suggests to me that they tried to sell their gourmet burger kitchen and couldn't at any price. That was the sense I got, that they were trying to sell and couldn't find a buyer.
Find anyone, give us some money.
There's reportedly plus 150 gourmet burger brands in the UK, not burgers, brands. So we've got Rockamama's and then a few independents.
And actually, even Rockamama's.
I'm not sure it's gourmet, but yeah. So the competition is fierce. But what this business rescue does is, what it really focused at is your unsecured lenders, which they won't have many, and landlords. So what it gives them the right to do is to frankly walk away from a lease. But before they do that, they will try and negotiate those leases down. And if they can't, then they walk away. So it will help them right-size the business. The terrifying thing is that they should know this, because they failed with steers in the UK. Wimpy's never really worked. it really was a rushed decision, and I appreciate Brexit happened literally days after the announcement and all of that, but it's been a disaster of an acquisition. And to conclude, so here's your top tip. When a local company that's done incredibly well in the South African market decides to do a large offshore acquisition, short the share. Because what they think is that they can take their local knowledge and drop it into a foreign market.
And it never works.
All evidence says no. And this is not uniquely South Africa. Look at Massmart, and there are many attempts to, sorry, not Walmart, and there are many attempts to move into different territories. South Africa, Mexico, Eastern Europe have repeatedly, again and again, failed. People are not cookie cutters. Markets are not all the same.
Okay, Simon, thank you very much for a nice wrap of the market as it currently stands. Red.
Red.
And, you know, despite the very short, I know towards the end of the month there was a short green shoot, and then it died.
And we are, just to put it in perspective, our market is frankly has fallen 20% from the highs, but we are only back at the levels of 2014. Unfortunately, that sideways band is we're still just going sideways.
Well, let's hope it's sideways and not further down, at the very least. Simon, thank you very much.
Always a pleasure.
And look forward to chatting to you for the last time next month.
Cool.
Thanks.